you were kind of on the ball with this. Obviously, it's your job to track this at Bloomberg. And I think over the summer, you kind of gave it a probability of 90%. I think you changed after Grayscale won its case, if I'm not mistaken. And you have proven to be very, very right. So congratulations on the correct call. What's your take on how things have transpired after the launch? Would you say this is a success? What are things you would like to see maybe better? Love to get your thoughts there.
Yeah, I mean, we went to, like you said, we went to 50% as soon as BlackRock filed, which we got a lot of flack for, but we were like, BlackRock knows something. And then 90% was after the Grayscale victory and after the SEC started talking with these issuers, basically giving comments and giving feedback, which was something they had never done before, which was weird. So that's when we went to 90%. But as you said, yeah, they launched. We were right, fortunately. I would have had to eat a lot of public crow on Twitter specifically, and even publicly and professionally in my job. I probably had to quit my job with how vocal we were on thinking these things were going to be approved. But yeah, you said in your opinion, these things are a success. I mean, anyone who's opining on this and saying these things are a failure, I'm honestly losing respect for them in some regards. Like stating that this was not a success is just a flat out like lie and ignorance of what the data is showing. These things have, on a net basis, obviously we've seen a lot of money flow out of Grayscale's GBTC, about 7.4 billion, but on a net basis, we've seen 5.4 billion come in. Net of those fees, I mean, net of those outflows for GBTC. So no matter how you slice it, the volume, the amount of trader interest, no matter how you look at this has been an absolute smashing success and some of the most successful ETF launches in history.
So how does that, like, I think 5.4 billion, maybe, Jacob, can you throw that up on the screen? Just James's table right here. Yeah, so here you can see the totals. You see 5.2 billion. This is as of yesterday, I believe. How does that hold up compared to other ETFs throughout history?
I mean, so if you look at IBIT and FBTC, the number 2 and 3 on that list there, they are like some of the fastest ETFs to ever cross $1 billion, right? And if you look at like just the newborn 9, as we call them, so the GBTC ones, as a group, they were the fastest ETF in history to cross $1 billion. Obviously, no matter how you slice this, there's kind of an asterisk there. So like if you're just looking at the newborn 9, it's like, oh, you're excluding GBTC. That doesn't count. And you're like, all right, we'll exclude GBTC and just look at a couple. We'll just look at these individually. And it's like, well, you're cheating because some of that money left GBTC and went to these other products, which, yes, that's true. But no matter how you slice this was an absolute smashing success, because that number that we just had up there was 7.2. Now it's 7.4 as of yesterday. That number is inclusive of a bunch of money that was in the FTX bankruptcy estate, which was not moving anywhere. So that was $1 billion, right? $900 million roughly that came out of GBTC and did not go anywhere. It just went to cash. There was a lot of money in GBTC that were, one, people were buying it basically to get cheap Bitcoin because it was trading at such a steep discount. But there were also people that were just trading it as a special situations opportunity, right? Yeah. This thing's trading a discount. I think approval might be happening, so I'm going to bet on approval. And a lot of these people actually went out and shorted Bitcoin and were long GBTC, or they were just betting on the approval and were planning to get out no matter what. They didn't want Bitcoin exposure. So we have 7.4 billion out of GBTC. Billions of that was money that did not come back into Bitcoin exposure, no matter how you slice it. You also had the Gemini Genesis DCG situation where DCG at one point owned like, I don't even know, 5% of GBTC shares, even more. So they owned a significant amount of Bitcoin that they are likely of GBTC that they have likely already sold. So some of that money is likely from the Genesis Gemini DCG situation. Again, money that's not coming back into other ETFs. So it's even bigger than the net flows would suggest, because money has left out. So like the new money that has come into these newer ETFs more than offsets anything that came out of GBTC. And then you have to take into account that the money that came out of GBTC, like I was just saying, didn't come back into other ETFs or other Bitcoin exposure. We know that for a fact, on the order of billions of dollars.
Yeah, because those are like, I mean, some of those things like the FTX bankruptcy estate, those only happen once, where you're going to sell all that, and that's kind of in the rearview mirror now. You brought up the Genesis and the DCG. I actually looked into that too. That it's interesting because there's a lot of dispute over how the creditors wanted to get paid, because they wanted to get paid in Bitcoin, right? They gave Genesis Bitcoin, and then while it's been stuck in bankruptcy, Bitcoin's price has really gone way up. And so they don't want to get paid out in cash at the time of bankruptcy. And so it's interesting because now Genesis, they have over like 60 million GBTC shares that they're going to sell, but a lot of it, they're going to actually just, the broker dealer is just going to buy back the Bitcoin because the creditors are going to get paid out in Bitcoin. So a portion of that is going to lead to actual sell pressure on Bitcoin itself, I assume. Like, wouldn't you say? But not all of it.
Yeah, so it's fun. Yeah, exactly. It's so people were like, they're going to figure out a way. So part of the problem with these ETFs, one of the things the SEC mandated is you can't do normal ETFs. You can just hand over the underlying asset and get back an equivalent value of the actual ETF share. So in this case,
Right.
you can hand over Bitcoin, get the shares back. With these things, the SEC said no. KYC, AML rules, they don't want brokers touching the underlying Bitcoin, even though they kind of are through subsidiaries, but that's a whole different conversation. Um, Essentially, there's no way to just take the Bitcoin out of GBTC. So the only way to get it out is to sell those shares. And then, like you said, buy that back if they're planning on distributing Bitcoin as part of the um,
Yeah.
as part of the bankruptcy estate. So some of it is going to be sold and likely going to come back, most likely in direct Bitcoin spot purchases. The one thing I would step back and say is no matter how you slice it, people are like, what happens with this money when it comes in or when it leaves? Like, how is this working? At the end of the day, there are a lot of things that are happening in between and intraday on what's going on here. At the end of the day, any sort of net flow going into these ETFs or out of these ETFs is going to show up in the spot markets, whether that's OTC markets or they have to touch an actual exchange. It doesn't matter. They need to go somewhere and they need to get their hands on physical spot Bitcoin as quickly as humanly possible for these ETF issuers. So all you need to realize is that when you're buying this ETF, you are buying, it's spot Bitcoin buying that you're doing or selling.
Yeah, can we talk a little bit about that of how exactly these ETF issuers are acquiring the Bitcoin? I mean, you say it's OTC desks. How much of it is coming on? They're going actually onto crypto exchanges and buying some, or have you heard of them buying directly from miners? Or and then when do they do it throughout the day? I think if you have any insights into any of that, I'd love to hear it.
So I will preface this with saying I've asked a lot of these questions, and for the most part,
Mhm.
people are keeping it rather close to the chest.
Got it.
Before I even get into like answering how I think about it working, you just need to realize that there's no the incentives are aligned for no funny business happening, right?
Okay.
These ETFs, if you're an ETF and you are like not getting exposure to Bitcoin as quickly as it's coming in, that's going to show up in your performance. You're going to drag. It's called cash drag because basically you'll have more cash than you're supposed to have in your fund. You won't be fully exposed to Bitcoin. And if Bitcoin goes on a run, then all of a sudden you're underperforming Bitcoin and your ETF looks like garbage. Or the other way, you could actually end up being in cash and Bitcoin goes down and you didn't go down as bad. That's still not good because what people want is a product that tracks the underlying price of Bitcoin.
Yeah.
So the incentives here are I want to make sure I have exposure to spot Bitcoin under any and all circumstances, right? So they're going to go out and they're going to OTC markets, they're going to OTC desks, institutional platforms, and basically putting out, we need this much Bitcoin. What can you get it for us? So they're basically putting all these like your Cumberlands, your Coinbase, your Kraken institutional desks, anyone you think of trading Bitcoin, for the most part, those desks, these ETF issuers are going to them and saying, we have this much in a creation order. We need to get this money Bitcoin and they're putting them in competition with each other. Some of them are just going to Coinbase directly and saying, get us this much Bitcoin, and it is what it is. And
Yeah.
I don't know exactly who's doing that. For the most part, the goal is there's a creation cutoff time, right? And this means the ETF issuers need to know when the APs and the ETFs need to know like how much shares are going to be created the ETF. And there's different cutoff times. Some of them are 2 p.m., some are 12 p.m., some iShares is actually 6 p.m. the day before. So you need to tell them the day before so they can get exposure to the Bitcoin. But what's really happening underlying is like the market makers that are saying basically putting these orders to authorized participants. So authorized participants are the people that actually go about creating these shares. So they're the ones that
Yeah.
are actually facilitating that process of putting cash into the fund and therefore in getting shares in return. And then it's on the ETF issuer to go out and get exposure to that Bitcoin. So once they know that creation unit's coming in, that ETF firm, say it's Bitwise or ARK or Fidelity, you name it, they know, all right, we have a creation order for this many millions of dollars. We need to get this many $1 million worth of Bitcoin. And they're going to go out and put it and try to get it, basically, is what's going to happen. So What you need to realize before that, though, is the market makers that are constantly out there with bids and asks on these ETFs, right? A market maker is just out there for the most part. These shares, if you and I, if you want to sell $10 worth of or $100 worth of one of these ETFs, and I want to buy $100, the matching engines are just going to match us. That doesn't have to touch underlying Bitcoin, right? It's when it
Yeah.
becomes lopsided where everyone's trying to buy a little bit more than there is. That's when a market maker will step in, and they have set bids and asks, and the market makers are incentivized by that spread. So the bid is X, the ask is Y, what have you. And they're basically they make money on that VIG, that little difference. So they're out there constantly creating markets. And if they get too lopsided, like if they're selling too many shares or buying too many shares, they're hedging themselves constantly with either other ETFs, futures, spot Bitcoin potentially. So they are already like delta neutral. So the buying, the actual underlying buying for the most part is happening before like the actual physical spot buying is happening OTC. There are issues, I guess, because like you need to actually settle those positions, and then that could get wonky, which is why
Yeah.
you see some of the crazy stuff that's happening close to the trading day. But for the most part, the buying is happening like throughout the day. It's just being hedged in some different way. And then they're unwinding those hedges and unwinding those trades once those shares are created.
hmm Yeah, those market makers are always kind of benefiting from those arbitrage opportunities as the shares trade at either discount or premium to NAV, right? And so
Yeah.
that's the beauty of the ETF creation and redemption mechanism, right? That's what keeps it kind of at NAV, and they're incentivized to do that because they make money off it. So it's pretty brilliant, honestly.
Yeah.
Um, yeah.
What these things, they will trade at minor discounts and premiums, like you were just saying,
How
but
have
it'll
they
be
been
nothing
doing? Yeah, just real quick, like in general, how are the ETFs,
obs-
Bitcoin
obs-
ETFs?
obscenely tight. So the first
Nice.
few days, the first even couple of weeks, the spreads were a little wider on some of them. So it was rather quick. So GBTC was the tightest spread. They were actually trading at a still like a discount, like a few days afterwards, because it was taking a while to arb that out.
Yeah.
Um, and a bunch of the other issuers were trading at premiums because more people were buying them, people were selling GBTC, what have you. But the spreads were tightened up pretty quickly. So within like a week, iShares as IBIT and Fidelity's FBTC had pretty tight spreads competing with GBTC. GBTC still had the tighter spreads for the first few weeks. And the discounts were kind of going away. And then the last, like after the first few weeks, even all the other ETFs, the total 9 new ETFs, they all have relatively tight spreads, like way tighter than you're going to get on most like regular trading platforms if you're not an institution trading
Wow.
spot Bitcoin. So, I mean, we're talking 0.02% trading spreads, no commissions, and then the discounts and premiums are virtually non-existent. They're very small. Um,
Which is just
so
another like, point of why it was such a success, right? That these things actually functioned properly and haven't had any outages and trade
yeah,
with really tight spreads. I mean, that's amazing.
I mean, we knew this was going to happen. Part of the reason why myself and my boss Eric Balchunas have been talking so positively about the ETF wrapper and why the SEC should approve the ETF isn't like, even if we hated Bitcoin, right? Like the ETF wrapper just works, and it's proven itself yet again with another new asset class. This thing has operated flawlessly as far as I'm concerned. And honestly, we knew this was going to happen. We saw it operate flawlessly in Canada. We saw it operate flawlessly in Europe, Brazil. Like this structure just it freaking works. Like there's not much else to say. And honestly, if I'm Gary Gensler or Elizabeth Warren, I was kind of hoping there was going to be a massive hiccup or somebody was going to screw something up. But honestly, it's done nothing but get tighter and tighter, less discounts, less premiums. The spreads are getting tighter. It's trading more efficiently. I mean, it's trading significant capital across the board here. I mean, this has been, I honestly can't think of anything that's been bad about this situation. I think some people had higher expectations than they really should have. But for the most part, like this thing has been an absolute smashing success.